Well, as we know, yesterday, Salesforce had a 20% decline. This is one of the worst declines in the stock's history in a single day, and they missed their revenue. Usually Salesforce does not miss revenue. In fact, that's incredibly rare. The last time that Salesforce missed revenue was back in 2006. So it was a unique day for Salesforce, but it also dragged down the broader software market. For example, we have Salesforce that was down 20% yesterday. It's now down around 14% year to date. Intuit, another world-class software company that's in a lot of different segments, this stock is also now down 7% year to date, after having a reaction after earnings and selling off more after Salesforce. Adobe, another world-class software company, down 25% year to date. This one has been on a steady stream downward all year. ServiceNow is also trading down this year, currently down 6% year to date. This is on a year where the S&P 500 is up 10%. And we have Workday, another enterprise software company that's currently down 21% year to date. This has been the year of destruction for SaaS companies, or software as a service companies. A lot of these enterprise giants are selling off because of newfound fears. In fact, it seems like just yesterday, we had a list of new fares show up. Now we have broadcasts on CNBC with guests like Adam Levy from Box going over how AI is going to impact companies like Salesforce. And it's actually going to impact their sales, and it's going to impact their growth, and it's going to hurt these companies. In only a couple of days, the narrative has shifted for these companies. No longer are they the beneficiaries of AI, they're being destroyed because of AI. And I think it's time that we observe what's going on in the landscape of software and separate fact from fiction. So I have a list here of things that I want to address that other people are saying on CNBC and common arguments I'm seeing about software right now. And I want to separate this from fact and fiction. We'll be breaking it down in this episode. Now, of course, we also have some other news to get to. Costco, one of my longest held holdings, is one that just reported earnings as well yesterday. Despite the very high valuation, Costco held up well. The stock is only down 2% after earnings, which, considering the run this company's on, the fact it's up 22% year to date, I consider this a win. And I want to go over why this company continues to do so well. What is the magic formula here? Why does Costco continue to win? Well, we have some interesting information that Costco decided to release in this report, and we're going to go through these highlights. And then finally, we have news that Bill Ackman is making big moves. And Bill Ackman is making big moves all the time. This time, he is eyeing an IPO for Pershing Square. They say here from the Wall Street Journal that he's wanting to capitalize on his investing record, which has been good, and his newfound celebrity on Twitter or X. So we have a lot to get to in this episode. Let's go ahead and jump in. We start off with the software sell-off. Like I mentioned, a lot of these top companies, Salesforce, Adobe, Intuit, ServiceNow, Workday, they're selling off big time this year. And now there's kind of a broad panic spreading across software. And I think it's good to examine not only Salesforce, but examine the entire industry. Now, I do have exposure to software through two different companies. I, of course, have my passive income portfolio here, and I own the big tech companies. I really like big tech. I think they're just the best companies in the world. So I have some Microsoft, that one's done well. I have Apple, but I also introduced Salesforce as a new position. The reason I decided to introduce Salesforce as a new position was on the thesis that this company was maturing. They were growing up. They were raising their margins dramatically while slowly growing revenue. And I love the story of steady revenue growth and margin expansion. When a company does that, they get their costs under control, they grow their margins, they grow their revenue. You see explosive free cash flow. And that's why I invested in Salesforce, to see this explosive surprise in free cash flow. And that is what we're seeing. This most recent quarter, they posted over $6 billion in free cash flow. It was a record for the company. This is cash flows, like Mark Benioff pointed out, that are higher than Coca-Cola. Salesforce is a cash flow machine, and they are meeting their goals and investors' expectations in both margins and cash flow. So that part of the story was fine. There was nothing wrong with it, but investors still punish this stock because they missed their guidance. But there's also more to the story. Investors are not convinced that Salesforce is an AI play. In fact, a lot of investors are now becoming convinced that Salesforce and companies like Salesforce are not only an AI play, but they're an AI victim. They're going to be damaged by AI. AI will damage their business model, damage their prospects, damage their customer base. The narrative has suddenly flipped for Salesforce and companies like it. And I think it's important to get narratives correct. I like stories. I like stocks that have good stories and good narratives, but the most important thing with a narrative is for it to be correct. So I think it's worth examining whether or not companies like Salesforce, companies like Intuit, are AI winners or are they AI victims? Are they companies that are going to be damaged by the future of AI? Let's go ahead and take a look at the argument that Salesforce is now an AI victim. This was an argument that was made on CNBC yesterday.
Salesforce's soft quarter, its shares are dragging the market lower, but might it just be the wrong software business model for the coming age of AI? Deirdre Bosa is looking at potential trouble in the cloud for today's Tech Check. Deirdre?
They start off by saying that it's in the wrong software business model in the age of AI. So Salesforce is just in the wrong place. Let's go see why.
So Kelly, enterprise software, it is the pain trade of the year, and Salesforce just added more momentum to that. But there is one corner that could be poised to recover and will benefit more from Gen AI than the traditional SaaS model that the likes of Salesforce has. That would be consumption-based models. Business models like Snowflake, Datadog, Confluence, MongoDB, which reports tonight, will be another piece of this enterprise software picture. Here's the case for it. If Gen AI applications are compute heavy, they require more usage of cloud computing resources or API calls, then consumption-based models naturally scale with the customer needs versus a Salesforce and others, which primarily sells on a subscription basis, often structured around a per-seat model that is charging based on the number of users that have access to the software.
So what they're saying here is that there's two different business models. You have ones where it's consumption-based, meaning that it doesn't really matter how many users a company has of your software. It just matters how much they're using. In the other case, the seat model, you actually have to pay per license. That's more like Adobe or Salesforce, where every additional user pays a monthly fee. It doesn't matter how much they use the software. Even if they don't use it at all, they still have to pay per user seats. So Salesforce is in this business model, the subscription seat-based per user license model that they now say is not optimized for AI. So this is more like a billing model. They're basically arguing that Salesforce does not have the right billing model for this new paradigm.
That is great when workforces are growing, but not so great if generative AI is making workforces more efficient and smaller. So you essentially have less seats, even though Gen AI workloads are increasing. I spoke exclusively to Boxio, Aaron Levy, on where we are in this cycle. Have a listen.
If you look at cloud computing, let's say, we are in 2006, 2007 in terms of cloud computing adoption relative to where we are with AI. So we have to kind of put ourselves back in that kind of position of how early we are in this technology cycle, and ultimately then how much upside and potential there is as it fully rolls out.
So there we have the argument presented by CNBC, but this argument isn't exclusive to this video. It's now being made everywhere. Now we have sentiment shifting for enterprise software application companies like Salesforce and Adobe. The argument is pretty simple, that these companies that rely on more and more users using their software to make more money are now the victims of AI because AI makes things more efficient. Think about this for a minute. If you have a company using Salesforce and Adobe and they have to hire more and more employees, they have more seats. They need more licenses, which means they need to pay Salesforce and Adobe more money. If AI comes in and it makes this company run more efficiently, efficiency means that you can do more with less. So the company needs fewer employees. Fewer employees to do more means that they need to pay Salesforce and Adobe less money. So that is the basis of the argument. AI is going to make lots of different companies more efficient, and efficiency means fewer employees. Fewer employees means that Salesforce and Adobe makes less money. Now, of course, I understand the logic behind this narrative. In fact, it sounds very viable. It sounds reasonable. But a lot of narratives that are incorrect also sound reasonable at first glance. What I'd like to do is just observe this idea that Salesforce and Adobe and these type of companies are truly in fundamental trouble because of AI. Let's go ahead and just go through some fact versus fiction here. The first fact worth pointing out here is that tech advancements have always made people more efficient. That's the history of tech, making things more efficient. I worked as a software developer for over 10 years. It was my full-time job before YouTube. And I can go over some of the history of this. When I first started, and this may date me a little bit, but when I first started doing software development, it was with languages like PHP, and it was procedural, meaning that you would write code line by line by line by line. And the way the computer would execute it is by line by line by line, top to bottom scripts. You would write code procedural. Now, over time, things shifted to what's called object-oriented programming. Object-oriented programming is a nice way of saying that you can now make things into objects centered around data, centered around different classes, and you can make it so that you can pass in parameters and variables, and you can reference things from different parts of the code. So no longer was it this procedural top to bottom, running things line by line. It was now a more organized code base that was in modules and objects and classes. This was a major advancement in efficiency in programming. It made every programmer better. You basically had to learn object-oriented programming because you could do so much more with so much less with it. It was more organized. It led to better, more efficient code. You could hand off code easier to some other developer taking over a project. You could do bug tracing better. You could do everything better with object-oriented over procedural. This was one major advancement that, although it didn't make any headlines on CNBC, this sped up the efficiency of coding dramatically. If we go further down the timeline, I also remember starting off coding in notepads, like a Notepad++. Now, there's nothing wrong with a notepad. You could write code in it, but they're not that powerful. And there's not much checking or helpful tools that go along with it. Then companies like Microsoft started to develop these advanced IDEs. They're integrated development environments. They're like notepads on steroids. They're super powerful. They help you with every part of your code. They assist you in auto-completing sentences, auto-checking for errors. They have your terminal built into it. You can automatically preview code. You can do all sorts of things. They integrate with GitHub or different repositories. IDEs were another advancement in coding that dramatically made things more efficient. So programmers became more efficient when they went from procedural to object-oriented. They also became more efficient when they went from notepads to IDEs. Coders also became more efficient when they stopped doing HTML and CSS directly and instead started to use front-end frameworks like Angular and React. And this also enhanced the capability of different websites that we use every day. These tools were developed by Facebook and Google. And then finally, we also have different efficiencies, not with coders, but with IT in general. We used to have locally hosted servers that were in companies. That was very commonplace. And although that still exists, now a lot of that is moving to AWS. That requires fewer employees for these companies. So you can see the examples here. Over time, the commonality is every single advancement in technology leads to more efficiency. When you try to look at AI as this unique or separate thing, that's fine. AI is unique and separate and it's awesome in its own ways, but same with every one of these advancements. All of these led to greater efficiencies and greater ability for one person to do more. The commonality between all of these things is even though they made coders and developers more efficient, we have more coders and developers working today than during any time in history. The number of jobs did not go away. The number of employees using these different tools did not go away. The entire industry grew and grew and grew. So that seems counterintuitive, right? You think efficiency means you can do more with less, so you'll have fewer employees? This showed the exact opposite. We did more with less, and we hired more employees at the same time. And that's typically how capitalism works. So the entire basis of this argument, that because AI is going to make things more efficient, these companies will hire fewer employees, and that way Salesforce and Adobe and all the different companies make less money, is proven wrong by every bit of historical data we have. So I don't see any evidence to suggest that AI is going to make it so that there's fewer employees doing fewer things around the office. If anything, history suggests that there's going to be more employees, but they're going to be more empowered by AI to do more than they normally could. Just like all of these tools empowered employees to do more. Now, the next thing I'd bring up, Salesforce missed their estimates. That sounds bad, but if you actually look at the guide of what Wall Street was expecting and what they actually missed by, they missed their estimates by 1.6%. The difference between 9.25 billion revenue and what Wall Street expected, 9.35. They missed by less than 2%. Missing by less than 2% caused Wall Street to become nervous about the stock because it was the first miss in a very long time for the company, and it results in the stock price falling 20%, which the stock price falling almost always results in poor sentiment. Try to name one instance where a stock has fallen 20% and sentiment remained the same. It never happens. Anytime a stock falls, people become more bearish on it. They become more concerned about it. We saw this with Netflix. When the stock price fell, everybody thought the company was over. We saw it with Amazon. Even Amazon, when the stock price fell down to 90, I heard people with tons of likes on Twitter saying that the company was doomed, that they were a Chinese flea market, that Temu and Shein were taking over Amazon's market share. All these concerns come out after the stock price falls. With Salesforce, again, when you look at the data doesn't look that bad. They barely missed on their quarterly guide. They restated their yearly guide. They generated over $6 billion in free cash flow. They're guiding for 20% earnings per share growth, 20% free cash flow per share growth. They're keeping their stock-based comp under control. These are not bad numbers, but yet the stock price falling leads to wild changes in sentiment. Another thing I'll mention is even with dramatic changes in industries, most of the time, now this doesn't happen every time, but most of the time the advantages accumulate to the top companies. These are highly scaled platform companies, meaning that any big advantage that happens in the world, most of the time they can pivot, they can turn their way into those advantages. We've seen it happen with Amazon, Apple, Microsoft, Netflix, all the highly scaled companies typically keep most of the advantages. And then finally, just the last thing I'll mention. AI is powerful. I see the power in it, the personal assistance, but it's not magical. It's not a magical replacement for Salesforce's tools. You can't replace everything Salesforce is doing with ChatGPT. And people that believe that probably don't have a full understanding of what Salesforce is doing. Salesforce offers an array of incredibly complex tools. AI is great, but most of the applications for AI right now are basically like nice chatbots, autocompletes. Those are nice things and they'll have a role. They'll help out with customer service. You'll see the little chatbots pop up and try to answer your question. And it'll be infused in different ways. In coding, it will help out as well. But again, these aren't magical tools that are going to replace everything that Salesforce does. That's just not the case. So I see this as having a more limited impact than people are saying right now. Sentiment is a powerful thing. It shifts quickly. And we're in a time right now where people are becoming incredibly concerned about AI and the impact it's going to have on software companies. And I think it's time to just take a breather. Because in most cases, things don't have quite the impact right away that people think they will. And as far as I'm concerned, a lot of these companies, the top tech companies, the SaaS companies, I think they're going to be fine. Now, moving on from Salesforce, we also have Costco that just reported earnings. I have to mention, like Salesforce, I do own Costco, and this is a holding that I've held a lot longer. Costco has been one of my core positions since the beginning of my portfolio. So we've had a bit of a long-term relationship here with Costco. And even before investing in Costco, I've always recognized that it's just a fantastic company. I love shopping there. I like going there. I think they have fun things to look at and buy. I love their return policy. I basically love everything about the company, and I'm sure that biased my view on it, but I think a company that takes care of their employees and the customer this well typically turns out to be an okay investment. In this case, it has been. Costco has been one of my biggest winners. I had less money to buy it 5 years ago, but I've continued to add to the company anytime it shows a dip. It's not a company that I like to trade in and out of. I recognize right now that a lot of people are saying it's crazy, it's insane to hold Costco because it's trading at a 46 forward PE ratio. Joseph, you're rational, logical. Why would you hold a company trading at that high of a PE ratio? I understand the concerns. I understand it's trading at a crazy PE ratio. I just look at it this way. This is a quote from Chuck Ockery from 2011. Chuck Ockery is a legendary investor. He didn't just beat the market, he crushed it, like doubled its performance for 20 years. He said in 2011, my experience, time and time again, is that I just never get the position back when I have made a timing and valuation sale. The great ones, those which compound the owner's capital at an above average rate for prolonged periods, are just too scarce. Chuck Ockery does not like selling companies because of valuation. Because in most cases, when he does that, those type of companies that he owns, the great compounding machines, they continue to climb and climb and climb, and then he can never get back in. And this works if these companies are truly unique and world-class. And I believe Costco is one of those companies. So despite the fact that it's at a crazy valuation, I'm not buying it today. The last time I bought Costco is when it traded at $500 per share. Now it's close to $800. I understand that, but I just can't bring myself to sell it. I don't want to try to time the valuation of it. I'd rather just hold on, and if it does have a big dip, I'll add to my position. When we look at what happened last quarter, they released this nice little graphic here. This shows some of the highlights from the previous quarter. The net sales were $57.4 billion, so 9.1% growth in revenue. An important thing to point out here is all of this is organic. So no acquisitions, no dilutive growth. This is 9.1% organic growth. Comparable sales, which is the same sales in the same locations year over year, grew 6.6%, which is very strong. It's just incredible they can continue to do this year after year. The amount of traffic is also going up 6.1%. Costco has a good e-commerce business, and they've tried to distinguish themselves from Amazon. Amazon focuses on small things, like everyday things you can buy on Amazon.com. Costco tries to distinguish themselves with what they sell online. Instead of going for the small ticket items like batteries and stuff like that, sure, you can get that at Costco.com, but you also get things that they don't sell on Amazon as frequently. Big ticket items, things like patio sets, barbecues, furniture sets, TVs. That type of stuff is very commonly sold on Costco, and they're getting better at it. When Costco first started their online sales, it was a mess. They often missed orders, they made customers upset from it, and now they switched over to their own fulfillment and delivery network, which they can better control. So we see good progress all across the board with their sales. I think the ultimate test for Costco is whether or not they keep their members happy. That is ultimately what's going to drive the company for the next 10, 20, 30, 40, or 50 years. Can they keep their members happy and paying for that membership year after year after year? The way that I gauge that, and I think the best indicator, is their membership growth and their membership renewal rate. And we have that at 93%, 93.0%. Now, on Qualtrim, we have a couple KPIs that I think really illustrate this well. If we look at the card holders, we can see the amount of card holders going up over time. This quarter, it reached 133.9 million. So they gained more and more card holders, around 7% year over year. That's an additional 2 million card holders just this quarter. So they're adding on more and more members into their exclusive warehouse. But if we look at the renewal rate, I think this is really, really important. The renewal rate this quarter was 93.0%. Now, if we look back one quarter, it was 92.9. So the renewal rate is going up. It goes from 92.9 to 92.8 to 92.7 to 92.6. We go down to 92.5, and then we get down to 92%, 91%, 90%. 91%, we get back to 2013 and we're at 89%, 87% in 2010, 86%, 86%. So we've gone from 86% back in 2006 to now 93%. The renewal rate is climbing over time. Not only are they growing incredibly fast, I mean, Costco just continues to grow steady every single quarter. This is the amount of warehouses they have over time. They're opening up more warehouses. They're increasing the amount of card holders like crazy. But at the same time, they're increasing their renewal rate from 86% to 93%. And they're still increasing it quarter over quarter. This is why this company is doing so well. This is why investors refuse to sell. They show no signs of weakness no matter where you look. The company is incredibly powerful. And that big question of whether or not they're keeping their members happy, there's no other way to say this than yes. In their established market, now 93% of their members are paying for that renewal fee every single year. And that's probably going to continue to climb over time. But this is still such an incredibly high renewal rate. There's just nothing like it. I think it's the best in the world of any company that I've observed. And then finally, one thing I find amusing about Costco is while most companies are touting their pricing power, how they're able to raise prices and offer more value to customers, Costco does the opposite. They tout how they're lowering prices on key items. Lowering prices by $1 on their shrimp, lowering prices by $5 on their pine nuts. Those are two examples. And then they highlight new items. We have some KS walking shoes. We have morning buns, lemon blueberry loaf. We have daily makeup remover towelettes, so on and so forth. These are the innovations, the striking new innovations happening at Costco. Now, of course, year to date, the stock is up 21%. It's down 2% today. I think this is a win given the valuation and the environment. And overall, I still think Costco is just a long-term winner. I'm going to continue to hold. Now, moving on, we have some big news from Bill Ackman. This is someone that makes a lot of headlines, but the latest one is that he's now taking his hedge fund, which is so far private, public. Bill Ackman is planning to take his investment firm public as soon as next year. The boldest move yet by the hedge fund manager to capitalize on his social media fame. As a precursor to a public listing, Ackman is selling a stake in the firm Pershing Square to investors in funding rounds expected to value the firm at around $10.5 billion. Such a listing, would one happen, would be an anomaly in the world of hedge funds. After a burst of debuts before 2008 and 2009 financial crisis, public markets soured on hedge fund firms. The management and performance fees that make up hedge funds' revenues can be unpredictable. Assets can shrink if investors yank their money out, and returns can be volatile. So a few thoughts on this. First of all, I think that Bill Ackman is one of the better hedge fund managers. Most of them underperform the market, especially when you adjust for fees. But Bill Ackman is one of the few that's beat the S&P 500 for the past 15 years, even after netting out fees, which is impressive. He's had around 17% returns. He's had a couple really big bets. Big bets in Chipotle when it sold off. He held lows for a long period of time, and that one was a great performer. More recently, he made some stumbles by selling out of Netflix at the bottom, but he recovered by buying Google at a decent price. So overall, I think he has great performance, and I think that he is going to attract a lot of assets. But even so, I'm not going to be investing in this because I ultimately like having control over my own money, and I don't want to pay hedge fund fees. The fees are guaranteed, the performance is not. So even in years that Bill Ackman underperforms or makes a bad investment, you still have to pay all the fees you agreed to, even if your investment's not doing well. And in most cases, hedge funds with their fees don't do well. Even if they beat the market without their fees, when you factor in the fees, it really eats away at the returns. You pay the fees on up years and down years. You pay them all the time, regardless of performance. I think this is good news. I like the fact that public investors can now get access to private funds. But as for me, I'm going to be sitting this one out. That's all for this episode. Hope you enjoyed. See you in the next one.